Okay, so let's start. Today is week 8, so we are talking about lecture 8, substantive test of transactions and also the balances. Because last week, actually, we have done in the introduction to the to the test of controls based on the sales case, actually. So this week, we are still around the sales cycle to introduce how to conduct the substantive tests. So before we start the lecture, we want to thank for the submissions of the assignments. All the groups have submitted the assignments on time and also in pretty good quality. And we have done and we will do the presentations this week and next week in the tutorial. And also because we actually spend 40 to 50 minutes each tutorial just to do the presentation, so we don't really have time to cover the tutorial questions. So if we can finish the lectures earlier today, we can go through some tutorial questions, but if we couldn't, we just leave those questions to later weeks, okay? So in today's lecture, as we have done before, if you have any questions, you can feel free to stop me and raise your questions orally. And you can also type in, but usually for what you typed in, I may not be able to check that frequently. I need to stop my talk and then check the chat box. So I think orally raising a question would be the best way for us to communicate. And also for the 3 weeks, because we are doing the substantive tests and also the auditing different areas in one audit engagement for this and the next 2 weeks. So we do have some flexibility. If we couldn't finish all the contents today, we can move apart to the next week or 2 weeks or in 2 weeks. So feel free to raise any of your questions so we can solve that during the lecture, okay? So what we're going to do today in the lecture, of course, we are still introducing some standardized substantive test procedures. But in the second part, we will focus on the revenue cycle. We are talking about auditing the revenues, receivables, and also the cash receipts, but still based on the substantive test procedures. And actually, we have another learning objective, which is audit sampling, but we just put that part as a reading material. So please read the contents after the class, and also this part is not examined in the final exam. On the other hand, I would like to know, so please try to understand the basic sampling methodology. So like the targeted sampling or the random sampling, etc. So because sampling is the most important way for us, for now, it's still the very important way for auditors to get samples and then to further do their test. So in objective 1, let's talk about the overview of the substantive test approaches. As we could always see, auditors has to obtain sufficient and appropriate audit evidence to support the auditor's opinion. So we have done the introduction of test of controls in lecture 7. So this week we are talking about the substantive test of transactions and balances. We know actually the test of controls and substantive testing procedures are the 2 main parts for the evidence gathering, for evidence collection in one audit engagement. So by doing that, So auditors are going to select the most efficient and effective combination of audit procedures and audit evidence, which will be enough for them to make a reasonable conclusion to achieve their audit objective, but they wouldn't collect too much with the considerations and the cost and the benefit for their audit firm and audit team. So as we have talked about test of controls before in last week, this week when we talk about substantive auditing procedures, we need to understand what is substantive procedure, what is substantive tests. Basically, substantive test is the test to collect evidence on the transactions, balances, and on disclosure. So I just give you this graph as a summary to the audit procedures, including test controls and substantive test procedures, but we focus on the substantive procedure part. So if we look at the substantive procedures, it includes test of details and substantive analytical procedures. In test of details, we have test of balances, test of in transactions, test of disclosures here. And actually, when we look at the substantive testing procedures, we probably need to realize, so when we do the, when we talk about substantive procedures, because when we are doing the audit, we look at the accounts and assertions, we are also looking at the overall impact to the financial statement. Therefore, when you do the substantive testing procedures, you will also have two different parts of concerns. One part is at the financial statement level. That in that level, your concerns are about overall presentations, overall compliance issues, overall disclosure issues. In other words, that is about whether the financial statements and the notes are presented and disclosed properly. And then, so we can have some examples there at the financial statement level, substantive test procedures. For example, for disclosures, the financial statement need to disclose all required disclosures as per the standards, regulations, and laws. For example, in most of the notes of financial statements, if the company has a going concern, uncertainty or going concern issue there, the company is asked to provide a going concern notes. So for the auditors, they would they will need to check if they think the company has a going concern issue, they are going to check if the company has a proper disclosure of going concern issue in their notes to the financial statement. So that's a part of the substantive test for the presentation disclosure at the financial statement level. Also, at the financial statement level, auditors need to check whether or not the financial statements are presented well. That actually means they need to check all the necessary parts required by the laws or the standards are included in the financial statement or not. All the components has been consistent with each other. There's no discrepancies in different parts of the financial statement. And also, is the overall presentation clear and easy understood by the readers of the financial statement, etc. So that's also part of the financial statement audit substantive test procedures. And in today, and actually in this unit, we focus a lot. Most of the part is focused on the specific audit area. So we do have today and the last week on sales, next week on payables, purchases, and then also the inventory, PPE, And actually in the real audit, you would also have a look of the equity section. You will also have a look of the liabilities. So in those specific audit areas, actually, we look at specific audit risk on accounts and on the assertions. So I think we all know what is assertion, right? So assertions are used to help auditors to assess risk of material misstatement and also help them direct their audit procedures in responding to those assertions. So in auditing those specific audit areas, auditors will focus on what are the key accounts and assertions auditors really want to focus in this audit, because different entities might be different in terms of key accounts, key assertions, and also key risks. For example, in each audit areas, some assertions are important, are material. And so materiality could be one criteria for the auditors to identify which account, which assertion they need to focus on. So when we look at materiality, you could look at dollar value. Let's say, so the example, so like last week's example, so when we are looking at the Telstra's financial statement, you could actually see I can't find my Telstra financial statements. Okay, so look at this Telstra example. So you could see actually they have the current receivables here, which is over $5,000 million, right? And compared to the total current assets, so the current receivables is actually over 70% of the total assets. From that aspect, you could see actually the receivable account is really, really important for Telstra's current assets. If we can further compare to the total assets, current receivable is also very high. So by evaluating the dollar value and compared to the total assets or the total profit, we can get the impression the receivable account is quite material. So this would be an account for us to focus on in this audit. Sometimes the account need your attention could be also by nature. So the account is still regarded as important material. It's not just because the dollar value, it just could be because by nature this account is quite important. For example, in your assignment, all of us are doing the healthcare industry. So if your company is CSL, so if the company's core business is about biotech, investigating how to do the medicine, how to invent a new medicine, pharmaceutical, like the treatments, etc. So which account could be very important? By nature, which account you feel would be very important? So if we are doing auditing on the health industry, on the healthcare industry, especially for the biotech company like CSL, So we know CSL is currently rushing to invent the vaccine and also the treatment, the potential treatment to the COVID-19 influenza. So it's like, so for this type of company, by nature, can you just guess which account you think would be very important, no matter how large it is?
I suppose expenses and assets, research and development, just how they treat those.
So if for this type of company, of course, R&D expenditure seems to be quite important. But if we are looking at one company, let's say CSL, do have a relatively reasonable amount in R&D. But if we look at another company, which is called LCS, for example, it has very, very limited, small amount expenditures on R&D. In that case, do you still think this account is very important, is still material?
No.
No?
Not, well, probably less likely if it's not a material expense account or it's not a material asset that's taken into the chart of accounts balance sheet.
Mm-hmm. Any disagreement? Mm-hmm. So from auditor's point of view, usually for this line of industry, I would always think R&D would be very important, right? Because by nature, if they are doing the biotech and as a core business, of course they are going to invest into research development. Otherwise, how come they are doing this line of operation? But if the company just report very, very small amount in this account, as an auditor, I would think it's more reasonable for them to report a larger number. So I would follow up to ask the management, why wouldn't you have a comparable level of R&D, which is comparable to your competitors or to your industry peers? So unless they are giving me very reasonable explanation, otherwise, I would question the balance in this account. And actually, I may think it could be high risk. Is this reasonable for you?
Well, CSL actually expenses all their R&D, and I suppose they have high R&D costs as expenses versus assets. And I suppose whether it's an asset or whether it's expenses, just where in that cycle it goes from research to development. So, you could have, like, we compared Cochlear to CSL, and Cochlear would probably get into the development cycle a lot earlier than CSL. So CSL, with its vaccines, essentially, it's all research because it doesn't get into development, or they don't consider it to be into a development phase until it's approved. So 99% of the expenses are done until it's approved. So that was their point on how they looked at, I suppose, R&D costs versus other healthcare people.
Okay, good explanation. So apparently your group is about CSL, right? Yeah, so what I mean here is, for certain companies, certain accounts by nature will be important, no matter whether or not the reported number is big or small, because by nature, this account will be important for this type of company, okay? And actually, in that case, if the balance of this account is very small, you could be more cautious about this account. Does it make sense? So when the account are material by nature or by dollar value, then these will be the key account at risk. Of course, on top of that, you will still need to discover what are the key assertions. So how can you identify the key assertions? For those key accounts, usually all the assertions could be quite important, especially some the occurrence assertion, completeness assertion, valuation assertion. Those three assertions are often very important for key accounts. And if we look at the other key accounts or key assertion risk, sometimes your preliminary analysis to this company can give you a lot of signals. So some signals you got from your audit planning and risk assessment can tell you some assertions or accounts are at risk. So listen to this example. So this company has a number of fraudulent payment to an existing suppliers last year. So as an auditor for the accounts payable account, so what is your overall evaluation to this account? Do you think the payable account would be of higher risk, need more attention from you?
Yes.
Yeah. So it seems, so some signals you got from your analysis, from your planning, from your risk assessment can also tell you maybe this account is at risk. Also still using this example. So apparently those fraudulent payments are paid to unexisting suppliers last year. So in this case, can you also capture what are the assertions at risk?
Occurrence.
Existence. So apparently, so it's occurrence existence because apparently they are paying to the accounts or payables not actually existed. Very good, thank you. So in those examples, what we try to explain is, so you can analyze the company, the nature of business, and also analyze the signals from your audit planning, audit risk assessment to identify accounts and assertions at risk. But after you finish, once finishing your audit planning, so you are going to do your evidence collection, to do your audit test. So when we do the audit test, audit evidence collection, last week we talked about test of controls. This week, we are talking about substantive audit procedures. Here, I also want to stress, so the substantive audit procedures sometimes could be doing together with test controls, sometimes could be doing after the test controls. So in what situation the substantive procedures are doing together with test controls or doing after those test controls? So test controls as a test whether control is in place, right? So it's always around the transactions as we learned from last week. And for substantive testing procedures, they are collecting direct evidence against accounts, against assertions. If the direct evidence is getting from the transactions, apparently they can doing together. Is that right? So when we are doing substantive testing procedures, we have test details, including testing of balances, testing transactions, testing disclosures. Testing disclosure is usually about the financial statement level test. And if we are doing the test transactions, it's usually doing together with the test of controls, which is also called as the dual purpose test. So what is dual purpose test? That means we can use one test to address both the test of control and test of transactions. For example, here we look at a very simple company. they only have 1, 2, 3, 4, maybe overall 3 transactions and some end of year balances. So your audit plan asks you to take a sample of sales records from the sales book. And then the sample size, let's say maybe 30, trace them to the invoices, sales order, those supporting documents. What here we want to check, excuse me, are you following? So here we are auditing this company, very simple company. We want to do a sample test on the sales records. And the sample size currently we want to do is 30 transactions, 30 sales transactions. When we are trying to do the sales test, you have 3 purposes. The first one, to get the evidence for the existence of underlying documents. Because we know actually for all the sales transactions, they should actually be corresponding to some underlying transaction documents, like the invoices, like the shipping documents, etc., like the orders, right? Second, you also want to check the order, shipping documents, and also the evidence matching, and also to check the signature, which means those steps has already been checked by the accounts or by the staff member in this company. On top of that, when you are doing this sample test, you also have another purpose. You want to check actually the matching details. For example, the prices, amounts, those specifications, or totals. We want to check those are correct. So in this sample test, we got 3 purposes. So do you think by doing those 3 tests, by doing this small sample test, are we serving both targets of test control and also test transactions? First, we want to check for all the recorded sales, the underlying documents actually exist. Second, for those underlying documents, we also want to check there is evidence of matching. So we also need to check evidence of matching and also checking the signature of authorized person. Third, in addition to 1 and 2, we also want to check the matching details to check the price, amount, specification, total, etc., in those documents. So by doing that, do you think we are actually serving both test control and test transaction purposes? Hello?
Yes, you do. You are doing both.
We have serving both test control and test transaction purposes, right? And then, sorry. Okay. So can you just also let me know, so for 1, 2, and 3, which are about the test control?
1 is about a test of control, 2 is about a test of control.
Mm-hmm.
Yeah, 3 is the test of the transaction.
So 1 and 2 are about test control. 3 is about the transaction. Okay. Is 3 also about test control? So for example, so if the matching details are not very correct, would that indicate control problems?
Yes. Yeah.
Yes, so 3 is about the test transaction, but it's also about test controls. Is that right? Okay. And still from that, we spend some time here, I think, because it is important. We actually talked about that last week. So what are the criteria for the test control and the test transactions? So suppose for the test controls, our criteria is, so 3% deviation is allowed. That actually means, so if the control, the number of control, the number of transactions which doesn't really meet this control requirement is lower than 3% of the sample size, then the control is still acceptable. So you wouldn't change your assessed control risk. But if the number of deviation is larger than 3%, that means the assessed control risk might be wrong. So you need to extend your sample, do more tests to ensure the assessed control risk is actually correct, or otherwise you need to change your assessed audit risk and control risk, right? And for the test of transaction, we still have the 3% criteria, but that is actually about 3% dollar value. 3% errors based on dollar value is allowed. So if we talk about test of transactions, we focus on the dollar value. Okay, so now listen, we have a few questions for you. So in testing result 1, no missing documents have been found in the sales sample, but in 4 sales, there was no evidence to show the documents have been matched by an authorized person, which a total amount of those 4 invoices are about $250. And $250 compared to $10,000 total value. So in this case, for the test control or test transaction, which one should be more focused on? So case 1. Case 1. So total sample value, 10,000. Sorry, should be 100. 100 sales transactions. Okay. So in case 1, what we found, 4 sales missing the matching evidence. which is equivalent to $250. So in that case, do you think it's more about control problem or more concerns from the test of transactions?
Test of control, because over the it's 4% versus 3%.
So the focus will be the control issue, because the deviation is larger than the 3%, right? So the control has got a problem. Okay, case 2. So still in this one, no missing documents. All evidence has been matched. However, when you inspect the documents, 5 transactions have documented incorrect pricing details, leading to overstatement by $200. So in that case, it's about a control issue, or it's more about the concerns on the test transactions.
Still a control issue.
So still the control issue, because the deviation over 3%. Okay, so case 3, no missing documents. All evidence has been well matched. However, when you inspect the documents, 5 sales has documented, 5 sales have documented incorrect price details. So 5 transactions, incorrect pricing details, leading to overstatement by $500. So in this case, what is your concern?
Both, as there's still 5 transactions, which is 5%, and it's over the 500, so it's both test of control.
So you actually identify problems from both test of control and also the test of transactions. So that here we just want to show you. So by doing this type of sample test, you can achieve both test of control and also test of transactions. However, the focus could be a little bit different. Okay. So based on that example, so apparently we could see actually there will be some benefit of this kind of dual purpose test, because this could save a lot of time for you. You can get the results for the assertion and also the controls at the same time. So in audit, we often do those tests, test control and test transactions together. Okay. The other type of test will be the test of balances. In test of balances, auditors test amounts resulting from the summation of a number of transactions, because balances are actually the summation of the transactions, right? So what's the difference between test of balances and test of transactions? Let's still using this example. So the balance, this $5,000, is actually the balance, the results of those transactions at the end of the accounting period. However, if we are doing the substantive test of transactions, we focus on the individual transactions, the sales, cash receipts, etc. But when you are doing the test of balances, we focus on the ending balance, which actually cover a lot of transactions. So my question here is, okay, so for example, we have those year-end accounts receivables here for this company, for Able. $5,000. For these $5,000, actually we also know is based on 3 sales or cash receipt transactions. So in your point of view as an auditor, how would you verify this balance? What is the most effective way you can think to verify this balance? This is about sales and accounts receivable, right? So for customer Able, it has accounts receivable balance $5,000.
So you confirm with the customer?
The first one.
Yes, but you'd confirm with Able what's owing to the company?
So you think confirmation would be the most effective way. Why?
Because it's independent and external.
So they are more independent. They are external. So based on our evaluation to the strength of the evidence, this seems to be the strongest evidence the auditor could get. So we prefer the confirmation. Okay. But for some reason, we couldn't get the confirmation from Able. We sent the confirmation letter to Able, but Able didn't reply. Then as auditor, do you have any alternative ways still get the verification to this year-end balance?
You could do recalculation based upon the transactions.
Is this enough?
Probably not.
So what should also be added in? So I think you are answering, right? So
yes.
Yeah. So 3 transactions here. We just do a simple calculation. Okay, so the summation is correct. So we tick off this year-end balance.
You could obviously get evidence of the underpinning sales invoices.
Okay, so in addition to the calculation, probably at least you should get evidence for each of the transaction. Or if you have millions of transactions, at least you need to get evidence for a sample of randomly selected transactions, right? So here, what we mean here is sometimes so the test of balance could have some particular way to get the evidence, but sometimes if you couldn't get direct evidence to the balance, you can always think about alternative way to get evidence for those related transactions. Okay. So test balances and test transactions are supporting each other and also should be, should be collaborating with each other. Okay. So the other type of the test here we mentioned would be the test disclosure, which are about presentation disclosure things. And so test balances, transactions disclosure, all of them can be called together as substantive test details. We haven't mentioned here substantive analytic procedures. Do you remember what is analytic procedures here? Have we learned analytic procedure before? Okay, so did you do your assignment?
It's just your ratio analysis.
So just ratio analysis, okay. But what's the point for you to do the ratio analysis as the auditor?
Just to give you, well, you can use it in all parts of the audit, but in planning, obviously, to point you in the right direction of where there might be audit risks. It's obviously a confirmatory on, I suppose, for sales or whatever, you can use it in terms of their sales ratios from year to year to have a look versus the number of transactions for sales. So it's a corroborating evidence as well.
So in the analytic procedures we did in the audit planning, apparently it's used for the audit planning's purpose. But here, when we talk about the detailed audit testing procedures, we also mentioned the substantive analytic procedures. Are they the same, or are they actually a bit different? They are not always the same. So the substantive analytic procedures are serving to provide audit evidence. Could be at financial statement level, but most likely is about different sections in the audit, different parts of the audit. So we are going to talk about substantive analytic procedures when we have a look of the sales cycle to see what are the analytic procedures they yearly do. So when we are doing the substantive analytic procedures, they would be more detailed, more about specific accounts and also specific concerns in one particular area. Okay. So, basically, so for us, if we are doing the substantive audit procedures, we need to consider how well we design those testing procedures. So at the financial statement level, you can always think about the high-level thinking, like going concern problem of this company, compliance issues of this company. So when you are doing evaluation to those issues, I think your professional skepticism would be very important, because you are combining different types of information together, and you need to be able to corroborating them and also identify something abnormal. And also, so when you are auditing different industries, so you need to consider the industry expertise and also industry characteristics, because the financial statement concerns could be different across industries. When you consider the overall financial report level design, remember that's the overall summation of all the evidence from different parts of the audit. So you actually highly rely on your audit evidence collected in different accounts and different assertions. And also, you should also focus when you are doing the financial statement level concerns. You should also allow for surprises. So after you collect all the evidence from different accounts, different assertions, you need to give you some space, because it's possible your audit evidence from one special parts of the audit is not sufficient. Like, let's say, so that's why we introduced the performing materiality. So you set 3% materiality level to all the accounts, but when you actually collect evidence, you probably only allow 2%, because maybe your sample is not so correct, it's not so accurate. So maybe you've got some missing things in your audit, so you give yourself some flexibility to use a lower performing materiality threshold and allow for unexpected outcomes in the overall financial statement. And also at the assertion level. At the assertion level, so that means the assertion, the audit test on accounts and on assertions, as we discussed previously. So some accounts, some assertions are always your focus. You should always do some tests on them. For example, the sales account is often material. For example, confirmation should always be done unless you couldn't do this. For example, inventory stock take is always important and they should always do this. Some accounts would be important for in some special cases. And if we can identify the key accounts and key assertions, so what about the other accounts or other assertions? From auditor's point of view, we have limited time. So basically we focus on key accounts, key assertions. And for those not key accounts, not key assertions, we can do minimal work, do a small sample size test. Or actually for some accounts, if we really think is immaterial, we can skip that, because if there's any problems in this account, it wouldn't affect the decision making of the users. Okay. So when you do your design of the substantive test, you consider financial statement level and assertion level, also consider the relevant risk and cost, and also the benefit. As we have done last week, so when you are designing the substantive test, you should also consider nature, timing, and extent of the substantive tests. The nature of the item has important influence on the auditor's selection of audit procedures. For example, for the existence assertion, likely the audit procedures would be physical examinations, external confirmations, or vouching to the transaction source documents, right? So when you have some accounts assertions in mind, you can naturally reflect those relevant tests, substantive tests, because by nature, those are the tests to those accounts, to those assertions. For example, if we are doing the auditing of cash, by nature, the auditor could count cash on hand, could doing the bank reconciliation to ensure, to verify the cash balance. But if you are doing the auditing for the accounts receivable, you couldn't really do that. I think the more appropriate way would be doing the external confirmation, because by nature, they are different. The other example of the important of the nature of the accounts is, so for example, if the accounts has been affected by only a few large transactions, the auditors could design their substantive test directly to those individual transactions in order to best substantiate the ending balance. Because in nature of this account, the account is comprised by those limited number but large amount transactions. So you can consider to use the transactions support evidence as an evidence for the balance, because it could also be quite efficient as well. When we design the audit substantive test, we should also consider what the assertion, because some assertions will be naturally relevant to some test. So we list something here, like so account balance assertions. Here we list existence, rights obligation, completeness, valuation, classification, and presentation. For example, if you are examining the existence of some accounts, what are the euro tests you can do? Hi, hello. So here, if we are testing existence for accounts, the normal test could be, for example, matching, vouching, because you are doing the inspection to the underlying documents to ensure the transactions are supported by the real transactions. Another type of normal test for existence, often used test for transaction is confirmation, right? And if the existence is about physically existed items, then you should also consider physical inspection, for example, to physically cite the PPE items, physically cite the existence of the inventory. So those tests are the natural test for existence assertion. So what are the frequently used tests for rights obligations?
You could review shipping documents to see who owns inventory and in movement, in transit.
So you review the documents which support the ownership. So if it is about transactions, smaller purchase or sale transactions, maybe the invoices and also shipping documents. If it is about larger amount based on some contracts, you can also review the contract. If it is about the ownership of a large amount assets, you could probably also check the title documents, etc. Because by nature, they are linked to the ownership rights obligations, right? Then for completeness, what are the natural tests to the completeness assertion? Completeness means so the evidence to show the relevant transactions have been recorded completely in the accounts.
You could do a check between, I suppose, the paper documents of like invoices, the number of invoices to obviously the number of transactions in the system to ensure there's a matching number.
So I try to type in here, yes. For existence, you can do inspection, right? You can do confirmation. You can do physical. For the second one, rights obligation. So the transaction documents, you can do the, you can review the contracts. You can review the title documents. So for completeness, we are also doing inspection to check if they are, so all the documents actually have been recorded in the accounts. And also what are the other very, very typical tests for the completeness assertion? So for important documents, we often check whether or not they are pre-numbered and sequentially accounted for. Okay. And also the other very relevant test would be the cutoff test, which is also quite relevant to the completeness assertion and also could also be relevant to existence assertion. So what about valuation? Accuracy, valuation, and allocation assertion.
Maybe also inspection.
Inspection. So what you are going to inspect?
Like documentary inspection, and that's pricing or summarize the account payable.
So you actually check the details of those underlying documents, try to matching all the details which are relevant to the values, right?
Yes.
Yeah. In addition to that, what would also be the typical test for this assertion? So we talk about the value. For example, the value of the accounts receivable account. So you got accounts receivable from company A, company B, company C. How would you ensure the total value is correct? We can also often do the calculation. Is that right? And also, for example, so when we consider the valuation issues, we know sometimes the value can change. So the change of value, for example, in the sales example, the accounts receivable value could change because some accounts receivable might not be collectible. So there will be the provision for doubtful debts, and which is based on the estimates upon in accordance with policies. So in that case, reperforming would also be a very typical tool to get the evidence for valuation and allocation. Provision for doubtful debts. Is that right? So classification. What would be the typical test for the assertion of classifications? Is often done also by the inspection, but will focus on the proper accounts, right? What about the presentation and disclosure assertion? Because it is at the financial statement level. You look at the financial statement level and also the no disclosure properly. So all those could be, so actually all the evidence from existence, rights obligation, completeness, valuation, and classification would finally have impact on the presentation. So here on this page, we just try to identify the typical test for different assertions. Please note, it is very important because when you design any test for any assertion, so if you know what are the typical tests for them, you can easily grab one and write it down. Okay, so let's have a break, and then when we come back, we are talking about the sales example. So we can just apply what we learned from the last hour into the auditing of revenues and receivables and receipts. And also it is very simple, just use our common sense. Okay, so I'm doing the recording conversion now, and I will be leaving for a few minutes and then come back to part 2, talking about auditing revenues and receivables and cash receipts. See you soon.